Hi, and welcome to this week's market presentation. Latest news. In the latest developments regarding the war in Iran, negotiations between the US and Iran broke down over the weekend, with the nuclear issue, especially regarding Iran's ability to enrich uranium, a red line for both sides that they have not been willing to compromise on. As negotiations broke down, President Trump announced that the US Navy would begin the process of blockading any and all ships trying to enter or leave the Strait of Hormuz, later clarifying that this would apply to ships going to or from Iran in a bid to prevent Iran from further energy profits. This has been a particularly important point of discussion, as Iranian crude oil exports had been increasing since the start of the war, with exports reaching 1.84 million barrels per day of crude in March and already reaching 1.71 million barrels per day of exports so far in April, which compares to an average through 2025 of 1.68 million barrels per day. China, the primary buyer of Iranian crude, would either have to look to other sellers or pressure either the US or other countries to remove the blockade of Iranian exports. The potential standoff between the US and Iran and potentially China regarding the blockade is increasing the geopolitical risk premium and the risk of unforeseen consequences and escalations in the war in Iran. Overall, energy prices rebounded on Monday as markets opened, with both global natural gas and crude oil prices increasing throughout the day. This was most notably felt for crude oil prices, which increased throughout today, with Brent trading at just over $100 a barrel this afternoon and TTF up to 48 euros per megawatt hour. Overall, energy markets remain very volatile and remain very sensitive to the changing headlines as more information comes out regarding the prospect of an end to the war or the prospect of further escalations. Over in Europe, in what could be a major political shift within the European Union, the newly formed pro-European Union TISA party, led by Peter Magyar, secured a decisive victory in Hungary's parliamentary elections. The new government is expected to shift policy closer in line with broader European Union policy, particularly as it relates to the European Union's climate and energy policies. On the energy side of things, Hungary, the government has signaled its intentions to move away from its reliance on Russian energy imports. And on the climate front, the new government is expected to be more in agreement with the European Union's climate targets and could provide a more constructive environment for upcoming negotiations on the European Union ETS market revisions and other Green Deal initiatives. Weather. Beyond the latest news and towards the latest weather forecasts, weather conditions across Europe are expected to remain favorable over the next 7 to 10 days, especially given the above average temperatures across Europe that are expected to weigh on both power and gas consumption. Precipitation remains limited over the next 7 to 10 days, while wind speeds are expected to remain largely unchanged over the next week. Macroeconomics. Macroeconomics, we've seen inflation figures released for the month of March. Looking at the euro area and the US, we can clearly see the impact that the war in Iran is having on inflation, with a rebound in year-over-year inflation in both regions. We can point towards the war in Iran and energy prices as a primary culprit, given the relatively stable evolution of core inflation. It remains to be seen if the impact on inflation will continue over the coming months. That will likely depend on the length of the war, but the increase in inflation will surely complicate the monetary policy decisions by each respective central bank. Crude oil and LPG. Moving towards crude oil markets, crude oil prices came down over the past week, largely due to the decreases on Wednesday following the ceasefire announcement Tuesday night. As noted earlier, crude oil prices rebounded on Monday as negotiations broke down between the US and Iran, with now both Brent and WTI at just around the $100 per barrel price level. The supply disruptions caused by the war has now reversed the oversupplied expectations in the market towards a supply deficit for the second quarter of the year, with markets balancing out and stabilizing starting in the third quarter. However, that is based on expectations that the war will end over the coming weeks. If it does not, we could see longer-term impacts to crude oil markets globally. Natural gas. Natural gas prices saw a similar decrease over the past week on the back of the ceasefire announcement, with particularly pricing for the rest of 2026 down roughly 13% on the week, the frontier for TTF down 12%. Prices rebounded so far this Monday, although still seeing prices down week over week. Beyond the war, storage levels are another important factor to keep an eye out. And over the past week, the favorable weather conditions helped lead to injections into storage, with storage levels increasing around 1% to just around 30% full. Injections, as we can see here, increased to the levels seen in 2024, higher than the injection rate we saw in 2025. Nonetheless, storage levels remain roughly 5% below last year's levels. Looking at total demand and supply, total supply remains near the lowest levels over the past 5 years, hampered by the decrease in LNG imports into Europe. Fortunately, the well above average temperatures across Europe have helped decrease total demand to the lowest levels over the past 5 years as well, which have helped contribute to the level of injections into storage. Looking at the supply mix, we see that continued decrease in LNG sendouts that began with the beginning of the war in Iran. Taking a look at LNG imports into Europe, we see that further decrease week over week, with levels of LNG imports now in line with the levels in 2023 and 2025. At the same time, we see that sharp drop in global LNG exports as well, now below the past 5-year average. Price competition between Asia and Europe remains strong, with Asian consumers continuing to outbid European consumers for natural gas. Given the favorable weather conditions and the bearish fundamentals domestically, we are not seeing pressure for European consumers to continually outbid Asian consumers, but the longer that the war goes on for, the more that price competition will intensify. Regarding the investment fund positions, we've seen those increase further as the war continues. Coal. Moving then towards coal markets, coal prices saw a decrease over the past week following the decreases in both coal, natural gas, and crude oil prices on the back of the ceasefire news. EU and UK emission allowances. Moving towards carbon pricing saw a slight uptick in the price level, in part because of the ceasefire news, as that would lead to less demand destruction that could have been taking place given the very high prices that we saw prior to the ceasefire announcement. Nonetheless, carbon pricing, particularly on the European side, but also on the UK side, remains noticeably lower than we were 3 months ago, before that bearish movement in the market that started around 2.5 months ago. Looking at carbon emissions from the power sector, we note those are the bottom of the range over the past 5 years, and this has been driven by the favorable weather conditions weighing on total demand, but also the strong renewable power generation in Europe. Investment fund positions are beginning to stabilize when we look at the European side of things, and markets reassess the potential market reforms that may be agreed by the European Union. On the UK side of things, net long positions remain near record highs as continued talks of linking the EU and UK carbon markets continue. Electricity. Moving towards electricity markets, electricity prices saw a decrease over the past week across the board, in line with the decrease we've seen for other commodities. The decrease were felt across European markets as well. Remaining towards the fundamentals, we see the sharp drop in total grid demand, pushing demand further close to the lowest levels over the past 5 years. Residual load also seeing sharp decreases again on the back of strong renewable power generation. Looking at the power mix, nuclear output remains just above last year's levels, with its evolution similarly to what we've seen over the past few years. Looking at total renewable power generation, it remains slightly below the record highs we saw in 2025, but the lower demand also means that it is able to weigh down total fossil fuel generation, which is at the lowest levels over the past 5 years. Taking a closer look at renewable power generation, we note the poor performance out of hydro in Europe, with wind power generation also easing off the highs we saw about a couple of weeks ago. Solar power generation continues to perform at record highs and is compensating for the weaker output out of wind and solar power generation. Looking towards fossil gas output, we note gas near the bottom of the range over the past 5 years as lower demand for fossil fuels and the high natural gas prices is weighing down on output. At the same time, while we did see a slight temporary uptick in coal-fired power generation throughout March, the favorable weather conditions have pushed down coal-fired power output once again to the lowest levels over the past 5 years. Lastly, looking at guarantees of origin, we've seen a rebound in the level of guarantees of origin. The upward movement largely driven by concerns over the supply of guarantees of origin, which even though right now outstrip current demand, the poorer performance of wind and hydro throughout 2025 and the less optimistic outlook for hydropower generation this year is weighing on future supply expectations. That covers this week's market presentation. Thank you for joining.